Well, let's welcome in Harish Krishnan, co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. Great to have you with us here, Harish. Appreciate you joining us. Your thoughts, Harish, as you're also someone who tracks sort of global cycles closely, and you got this big event which is being sort of decided upon as we speak. It may take a few hours, but for emerging markets in India, Harish, as a CIO who manages all kinds of sort of funds and oversees a large pool of money, who's better, Trump or Harris?
Good morning, Prashant. So I think, while all eyes are on the presidential outcome in the United States, I think it's equally important to see what happens to the Senate and the House, and whether we're going to see a sweep or we're going to see a divided kind of a mandate. Markets generally, prefer divided mandates because there is reasonable checks and balances and reasonable amount of policy continuity. A sweep in one side, I would think, will need a reasonable reset of expectations by various market participants. Also, over the course of the last month or so, there has been a Trump trade of sorts. So if you look at the US bond yields, which has risen quite sharply over the course of the last 30, 40 trading sessions, clearly in anticipation of the fact that there could be potentially higher fiscal deficits, and that's also played through in terms of the currency with the dollar strengthening as well. So I think a lot of these potential outcomes are already in the price. I think what is going to be the key thing to watch out is whether it's going to be a full sweep or whether it's going to be a divided mandate. And that has interesting ramifications. More clearly, we have the Chinese policymaking coming out, I think, in a day or two. They are also watching out this political outcome in the United States because there is reasonable amount of bluster that has happened during the campaigning wherein China has been called out and tariffs and sanctions have been used quite liberally by both of the candidates, and therefore the policy response and the fiscal stimulus from China is going to be keenly watched out for. So I think from an India perspective, I would rather sit and wait out this entire kind of events and then take a far more decided stance depending on all of these potential outcomes.
Yeah, that's very true. Harish, great to have you on. Good morning. I think by the same time tomorrow morning, we'll be back to discussing, okay, forget US, it's over and done. Now what's happening to our earnings, right? That's how it moves. But, we had a guest earlier on the program, a foreign guest who was making the point that irrespective of the outcome, and especially if Trump comes in, you can't take away from the fact that the first big trade is likely to be to buy home assets. US large caps, US mid and small caps, which have been ignored up until now. So if that happens, and if the US remains the preferred port of call, at least for foreign investors in the near term, then what? Because we've just coming off a really difficult October. Do you think the worst of the India correction is over?
So I think, part of the reason of the correction and, the severity or the ferocity of the fall that we've seen in October is potentially a catch-up for that excessive buildup of market cap that we've seen, especially in the last 6 months or so. I specifically call out the last 6 months primarily because there were three key negative developments. You had an electoral verdict, which wasn't really what the market was anticipating. You had capital gains taxation being tinkered. And then you've got now 3 consecutive quarters where earnings numbers have got cut downwards. And therefore, some of the reaction is to take into account each of these 3 events. I think the point that you're referring to is that where do the flows move, especially when we have seen close to about $12-13 billion of outflow over the course of the last 20 or 25 trading odd sessions. The sense that I get is for a lot of international allocators, India is now moving to a must-own category. From a small peripheral kind of an allocation that many global allocators had, I think that India is coming onto the center stage. The only point of worry that most capital allocators always had was the excessive valuations that was there. And a lot of that froth is starting to get corrected. In fact, I pushed out a chart sometime last week, wherein, if I plot the India share of market cap, that has now come down from about 4.4% of the world market cap, which it was in, say, August, September of this year. It has come down to close to about 3.6%. As it slides, comes to say about 3.4 or 3.45, which is under 7-8% relative underperformance that India is likely to see. I think those would be extremely good levels for a lot of international allocators to come back into. So yes, in the near term, that could be some kind of a home bias. There are a lot of small caps and mid caps, as you rightly called out, Surabhi, that are quite cheap in US. But I think foreign allocators will not miss up on the chance to reload back on India should we see a reasonably sharp 5-7% relative underperformance from here as well.
Hi, Harish. Good morning and good to see you, Ben. Which is the sector, though, that has run its course, which you believe valuations are full and you'd rather take money off the table?
I think, PSUs and defense, that back, even after the moderation that we've seen in the last few quarters, I think still there's been a significant amount of monies that have been made in that whole pack over the course of the last 2-3 years. Clearly, there is earnings visibility in those spaces. I'm not saying that there could be an earnings disappointment, but when they are trading at, say, 14-15 times price to book, the margin of error is reasonably very, very small. And therefore, we think that could be one bucket that sees a reasonable amount of underperformance from here as well. I think there are pockets that are starting to emerge even in real estate, where we've seen significant kind of market cap growth over the course of the last 2-3 years. There has been reasonable amount of overheating in the form of price appreciation, especially when we think about markets like NCR or Hyderabad, etc. These micro markets have seen significant price increases. And therefore, there could be some kind of cyclical kind of a reversal of that sort. And this is again a space which has done very well. That's again a space where we would be watchful for and would want to book out or to reduce our exposures going ahead. The spaces that seem to look interesting to my mind would be, say, metals, cement. These are two ignored spaces. In fact, if I were to look at the market cap share of these sectors, you have to go back all the way to 2001 for metals and 2004 for cement to get the same kind of market cap share. So obviously, the infrastructure build out that's happening in India, I think there is going to be a reasonable amount of metals and cement that is going to be used. The real estate cycle that we are seeing, that's also going to use a lot of these basic materials. So I think that would be a space that looks to me like a dark horse sector to which monies can be allocated towards.
Look at the market go now, 130 points higher on the Nifty. So we're at about 24,350. We'll have to see, if the strength really sustains, or we'll have to I think we'll have to give it a few more hours, but it was a powerful reversal from about 23,800 yesterday. And that rebound, thankfully, is continuing as we speak. So 24,340 is where we stand at. Market breadth is very positive, and I think that is even more heartening. But it's still early. 2,000 stocks are higher, and about just under 400 stocks are trading in the red. Harish, we'll leave it there. Thank you very much for being on, and hope this is the first of many. Seeing you after a while, so hoping that we get an opportunity to speak again and sort of expand on some of those points a little bit more. Thank you for being with us here this morning. But